Ken, as we preview banks and big bank earnings, let's start with Citigroup. The headline. What do you think the headline might be? What are you expecting?
Well, it's great to be here. And Citi is moving forward with its transformation. It announced just a week ago the sale of Banamex, which is their Mexican consumer bank. So over the course of the last 2 years, they have exited consumer banks outside of the U.S., except for some key markets. And they have simplified their businesses and also how they report. So what we're seeing for Citi is a more reliable performer than we did for many years.
So they flagged recently, or in their last earnings report, a stronger full year revenue, something perhaps greater than $84 billion. Do you think we're going to hear they're still on track? Might they even be headed towards something better?
Well, I think Citi's in a great position in terms of benefiting not only from a strong U.S. economy, but also the capital markets really opening up almost to a risk-on environment. That would not have been the conversation going into May of this year, but what we have seen is very healthy investment banking as well as trading. We're also seeing that so long as the U.S. economy grows, something for banks that is important is net interest income. The volumes will help drive that metric, even if rates come down a little bit.
In the quarter, what's a figure, a metric, a performance indicator that I should use as a benchmark for whether they're on the path to further growth or there's a problem?
So the other key metric at large is non-interest income, which is a host of businesses. Some are very durable and recurring, which would get into corporate treasury services, custodial, asset management, wealth management, and then the delta, which would be, seeing some outsized gains in the third quarter, but also the company's guidance or what analysts might think is the outlook, particularly for equity and debt underwriting as well as M&A. One key area gets a lot of attention on Citi in non-interest income is card income, credit cards. They're one of the top 3 players in the country. And we expect to see, because the consumer is still spending, some pretty good growth there.
But with the interest rate environment changing and expectation for more cuts, that's going to compress their NII, isn't it?
Well, it may or may not. Spreads could still be pretty healthy. I pointed again that when you look at all the mechanics that go into net interest income, loan volume is very critical, or perhaps the activity that we see from their clients in the capital markets, that also drives net interest income. Bank analysts have a habit of sometimes being too bearish when they see rates go down because they're not thinking of volume.
Regarding investment bank fee growth, is there a metric that would tell us that they're on the right path to future growth or that there is a problem?
Yeah, it's very simple. It's really 3 metrics: equity and debt underwriting as well as M&A. That gets you to the number we're looking for.
And are you optimistic? What do you think we're going to hear from Citi?
So we were optimistic in May, and we went with an overweight, not only in the financial sector, but for the global U.S. banks, very positive. And we continue to have a buy recommendation on Citibank. And we've continually raised our target price. I don't have it off the top of my head here.
Let's shift to Morgan Stanley and how important their successful appeal to the Federal Reserve to reduce the stress capital buffer was. We're not going to see the results of that in the report, but what does that mean for them going forward?
Yeah, so that's probably the end game here. When we look at performance for Morgan Stanley is return of capital. So the ability with the June Dodd-Frank stress tests and the changes made in the buffer gives them room. They have plenty of capital and reserve, and they are not a traditional bank, so they don't have as much loan risk exposure, nor do they have rate risk because net interest income is a smaller percentage. It's in the teens versus 55 or 60%. So what's interesting for the third quarter, we look back over the last 6 or 8 quarters and stack up the top 5 banks. Morgan Stanley is one of the top 2 in terms of having outsized beats to revenue and earnings.
If I'm a novice investor, but I'm looking at Morgan Stanley, is this also going to change the playbook going forward for buybacks and dividends, or do you think they're going to hold the line?
I think they'll be prudent. I think we can see potentially low teen return on capital for them. I don't see any reason why Morgan Stanley and also Goldman Sachs will be ahead of the pack here for the reasons I've mentioned.
And then regarding IPO and M&A activity, is there a trajectory? Are we expecting a normalization? Are we expecting improvement? And what would that mean?
So if you go back 2+ years when rates were rising, we did see a slowdown in equity underwriting, in particular IPOs. To my point before, it began to pick up in June. It has continued. And of course, technology with AI has been one of the engines, but there's been other areas as well. There's also, I'm one of the 3 analysts that cover not only the large banks, but the large alternative asset managers, private equity firms, which have $2 trillion of company-owned equity that they need an exit ramp, which, of course, one choice could be IPOs.
Let's shift to Bank of America. And one of the things that I look at, just as a crazy person, is the Bank of America Institute reports that they make free to the public. And they talk about the consumer a lot. And how dependent are they on the average American and the consumer? And what's going to happen to them, especially as we're seeing, they talked about wage growth was still strong, but in a recent Institute report, they talked about the consumer is under pressure. I didn't understand how that could be, and what's the impact for that?
Well, each quarter, CFRA, we look at all the banks in terms of delinquencies and key metrics related to potential provision for loan losses and allowance for loan write-offs. And we're still in a normalized range. Nowhere are we seeing any concerns related to the consumer where we're going to see outside reserve builds, in this case for Bank of America. Now, keep in mind, when we think about the consumer, what we've seen for Bank of America and JPMorgan Chase or Wells Fargo is they tend to be trying to service the higher demographics or the higher FICO scores. So they're less at risk than perhaps some of the consumer finance companies with their card businesses or consumer loans.
So I want to repeat what I think I just heard you say to make sure I heard it correctly. You're expecting the banks to actually accelerate or see growth in loans to regular people,
yes,
especially with interest rates coming down?
Absolutely, yes.
Well, do you think that they will loosen their underwriting standards as they do that? I mean, as you and I are both old enough to remember what happened the last time underwriting standards.
No, I remember it very clearly in 2008. And the answer is no, because again, when you look at the largest U.S. banks, they're mostly targeting the best customers. And if you're not a best customer or one that is they definitely don't want to go into subprime or FICO scores below 650 for the consumer. And then everything is more of a bottom-up review of small business or corporate. So I think they're going to do really fine.
Jamie Dimon is making lots of headlines, and I realize the news media loves the panic headline. And the panic headline du jour right now is that he's predicting a big correction in equities. The bank, I remember back in 2008, 2009, he's considered the best banker on the planet because of the way he steered JP through that crisis. But his doom and gloom predictions, does it have an impact on JPMorgan?
Well, you always have to plan for the worst and hope for the best. But Jamie has a habit of talking away from his book, which is outstanding performance over the last 6 quarters or few years across all of its businesses. I would say before we leave, Goldman Sachs is our strong buy. It has been by far the best performer in each of the last 6 quarters, and it has the delta for outsized gains from the capital markets and investment banking. So the one that all of these banks look to be good, and the laggard, which is our only hold in the discussion here, is Bank of America.
For the reasons that we kind of alluded to, but as we wrap up, what's the most important thing? You just shared with us something I think is valuable for investors. What's the last thing you want to leave them with?
I think it's confidence in the U.S. economy, and also that we have the greatest banks in the world, and they're not only enjoying the benefit of growth here in the U.S., but they are gaining wallet share in other markets around the world.